Free cash flow for the quarter was at an all-time high of $1.26 billion. Headcount grew by over 5,000 sequentially, where we are now over 323,000 employees worldwide. Financial services in the US continues to grow strongly in this quarter and over the past few quarters. We've seen a revival in European financial services during Q3. We are seeing an improvement in retail and consumer product industry in the US, with discretionary pressures easing. Automotive sector in Europe continues to remain slow. In generative AI, we have built 4 small language models for banking, for IT operations, for cybersecurity, and broadly for enterprises. In generative AI, we are also developing over 100 new agents. These agents are for deployment within our clients, many of them already using agents that we've developed. Based on our strong performance in this quarter and our view for the rest of this financial year, we are revising our revenue growth guidance to growth of 4.5% to 5% in constant currency terms. Our operating margin guidance remains unchanged at 20 to 22%. With that, let's open it up for questions.
Thank you, Salil. We will now open the floor for questions. Joining Salil is Mr. Jayesh Sangharajka, Chief Financial Officer, Infosys. The first question is from Ritu Singh, CNBC TV 18.
Hi, Salil. Hi, Jayesh. Happy New Year. Let me just start with that revenue growth that you've posted, because Q3 is typically a seasonally weak quarter. The market estimates were about 1% growth, but you've been able to deliver 1.7%. So is the environment significantly better than what you saw 3 months ago? One, if you could give us a commentary on that. And on raising your revenue guidance to about 4.5% to 5% wasn't expected lines, but what is the implied growth rate for the fourth quarter then? Are you expecting a degrowth of about 2.5%, given this margins that you've given? Also, your wage hikes, I think last time we asked you and you said it may happen in the fourth quarter. If that is on track, and what will be the impact on margins once you do undertake that? And hiring again, has been going up for the last 2 quarters. How should we read into that? Again, coming back to your revenue question, if you're expecting a degrowth in the second quarter, will you continue this pace of hiring? What is the demand outlook? And if I may add, deal wins, while they've been steady, they've not really accelerated. If you could give us a sense of what the pipeline looks like from here on. Thank you.
So thanks. I'll try and go through the question, and some Jayesh will also answer. On the first, I think the sort of view in Q3, and it was the growth at 1.7%. What we saw was, the last quarter we had seen discretionary becoming good in financial services in the US. Now this quarter we have seen financial services in Europe, also the discretionary is showing signs of improving, and on retail and consumer products in the US is showing that signs of improving. So that coupled with how we delivered in the quarter was the reason why we changed the guidance to increase. Now the second, I think, was about, if that is the guidance, what is the Q4 and so on. So there, first, as we've always shared, our Q1, Q2 in a typical financial year are strong. Our Q3, Q4 are typically weak. So that's the sort of seasonality that we see in Q4, nothing more or less. Jayesh will give a little bit more color on some of these points. On the hiring that you mentioned, there I'll say a few words and I'll pass it on to Jayesh. We've had a strong hiring in Q3 with this expansion of over 5,000 employees. And we see that based on some of the discretionary, this will continue, but it will have seasonality as we see in our revenue. For the next financial year, we are obviously not giving the growth guidance, but what we do see is that many of the things we've put in place across the whole company, focused on large deals, focused on small deals, focused on artificial intelligence, making sure we're doing cost takeout for clients. All of these things combined are helping the company to execute as well as it's doing. So let me pause here if there's anything else.
How much of it was organic, how much inorganic because of the Intech acquisition, that as well?
So Intech, let me just answer that and I'll go back to other questions. Intech was, last quarter, we had pretty much 2.5 months of Intech. So this quarter, the Intech was roughly around 20 pips in revenue. Coming back to the other points, if you look at large deals, our large deals, while the overall large deal number you will see is remaining same, within that, the net new has increased significantly. So last quarter, our net new was 40%. This quarter, our net new is 60%, which means that the large deals per se, or the net new TCV of the large deals have gone up 1.5 times, between Q2 and Q3. Our large deal pipeline has become stronger, as we see. So all of that has led to our increase in guidance, just to add to the points that Salil was making. Coming to the other question on comp, we had announced earlier that comp will happen in 2 phases. One phase from 1st January, the other one will happen from 1st of April. We are on track with that. The first part of the comp is getting rolled out in this quarter, and we are working with HR on that. So our HR team is working on that.
The question rather was, what will be the impact on margins?
We don't define the impact on comp, exact impact on the comp in terms of margins. So we will have some headwinds coming from the comp in Q4 and Q1 based on it. But, broadly, the comp that we are expecting is 6 to 8% in India, and, the overseas comps will be in line with the earlier comp reviews.
I think, Salil, the question on discretionary spends on high-tech, telecom, some of these areas that you'd continue to flag in the last quarter, if the outlook on that is improving, and if the BFSI momentum you expect to continue into the new year.
So on high-tech and on telecom, we've not seen a change. What we've seen the change is really on financial services, more in Europe, and on retail consumer products in US. Will it continue at this stage? That's what we're seeing in terms of what we saw in Q3, but we'll wait and see how it looks beyond that.
Thank you. The next question is from NDTV Profit, Haripriya.
Hi, Salil.
In terms of what we saw in Q3, but we'll wait and see how it looks beyond that.
Thank you. The next question is from NDTV Profit, Haripriya.
Hi, Salil. On the discretionary spending part that you mentioned, is this kind of change that you're seeing is only sentimental, or you see this translating in the budgets, in the upcoming budgets for the companies across the sectors that you mentioned? And also with the new administration coming in the US, what's the kind of impact that you're expecting from that? The market expects the stability to bring in a lot more, budgets to open up a lot more. And also on the employee headcount, the attrition is also rising a little bit more, if not gradually as well. So how do we read into that? And on the margins, what's the kind of impact the cross-currency headwinds have had? There's a lot of movement that has happened in the currency. And also, would there be any furloughs or spillover? And in the long term, you have had a guidance bind for margin, and it is there, but also it's quite narrow. And so in the long term, what is it? How is it that you choose to improve on the margin part, given that there's also a margin project improvement that you have?
So let me start off with some of them. The first one was on the discretionary. The budgets for our clients will be on a calendar year basis, which will start now. So we'll get a sense in this quarter itself. Our commentary is mainly on what we've seen in Q3 and how the discussions have been going. And that seems to indicate the changes that I mentioned. In terms of the new changes in the US, we'll wait and see how it goes. Generally speaking, most people who are the economists and so on have a view that the economy there will do better. That's what our clients are saying. But we'll wait and see how it goes. We have a business that works in those growth situations, in the cost situations. So we're feeling quite confident in terms of the outlook there.
So what's the dependency on the H-1B visas? Do you see any impact there?
So there, maybe you want to go?
Yeah, our mix has reduced significantly. We used to be in the 30% range. We are now at 24% range. Within that, our nearshore has increased significantly. And within the on-site, the US on-site population that we have, our our H1 depend or our H1 independent folks are now 60+%. So we have now built a pretty resilient model from that perspective, and we are therefore much more confident from where we are versus where we used to be earlier.